What's going on, guys? What up, Jimmy? What up, Joseph?
Hey,
How you
what's
guys?
happening?
How you guys doing?
Good.
I hope you guys got some good weather. I mean, it's been absolutely amazing out here. Um, and now today it's been pretty rainy, but when the grass grows, I make money, so I'm okay with it.
Very good.
All right, well, we'll just get to reading, guys. I want you guys at any time, if this involves your process, what I'm going to read, I want you to articulate on it in some way, or if anything gets you excited or euphoric in any way, like I want to talk about it. And you guys keep showing up to these things. And I honestly, I love reading this. I like having a little study group. My wife kind of makes fun of it and says it's like a reading club, but I honestly love it. I do. I love it. I'm a nerd, and this is what we do, right? So thank you for showing up and bettering yourself and kind of hanging out with me. So if you guys have anything at any time, let me know. But first, I want to go back just over really quick. B Stewie and I kind of got together to highlight a few things just before we start entering the second part of this chapter too. Hang on, I lost my page here. 258. So in chapter 11, um, we read through chapter 11. We only made about halfway through this chapter, but some of the most monumental parts of this is what I like to see is like William O'Neill's kind of like getting his process together, and he's piecing everything together by saying he got it from here, 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 and what he noticed in his experience. And so I want to just go over that. So he one of the big things that he took from Jack Dreyfus was that he would concentrate on a listed stock that sell for more than $20. So he's basically saying he's staying away from those penny stocks. He's looking at things that are listed in the NASDAQ that aren't considered a penny stock, right? And then he's looking also for something with institutional acceptance or ownership. Just like you see in CanSlim, the I in CanSlim is institutional ownership. And this is where he's finding it is from Dreyfus. And then he goes on to say he wants to see increase in earnings. Quarterly and earnings are up at least 20%. So he's looking for that exceptional growth in these listed stocks. He also goes on to saying he wants to look for breakouts that are accompanied by volume increase. And if you guys have been with me long enough, I always say, I only zoom in on the 5 minute when I'm looking for that volume, you know. So I want you guys to always keep that in mind that what he's talking about there is super important. And then as he continues, he starts talking about Jesse Livermore. And if you guys don't know about Jesse Livermore, you'll know. Hang on, this might be important. Is everything okay? Okay, I'm gonna do my Discord. I love you. I love you. Bye. I think she may have forgot, but I just want to make sure it was important. Um, then he talks about Jesse Livermore, and if you guys haven't already, you need to watch Jesse Livermore or listen to the story, Reminiscence of a Stock Operator. It's free on YouTube. Go look it up right now, and then come back and listen to this because Jesse Livermore is absolutely awesome. But averaging up is what Jesse Livermore talks about. And he takes this technique where your initial stock purchase, you buy additional shares of the stock when it moves up in price. This is usually warranted when the first purchase of a stock is made precisely at a correct pivot or a buy. So how I show you guys those basing breakouts, the trend breakouts right as they go through up on volume. If you buy it at the precise pivot and buy point, and the price has increased 2 to 3% from its original purchase price. But if he was wrong, he would eliminate that ad immediately if it dropped below a certain amount. So whatever your intended risk reward level is, he would exit that out, the full position after adding. And I just want to read this one more time. This is usually warranted when the first purchase of the stock is made precisely at a correct pivot or buy point, and the price has increased 2 to 3% from original price. So actually, I'm glad we reread that because I actually used to think it was he would only add below 2 to 3%, but it needs to be up 2 to 3% before he can add. Another thing was after he was doing his revised profit and loss plan, he made a rule that he'd buy each stock exactly at the pivot buy point and have the discipline not to pyramid or add to his position at more than 5% past that point. Then I'd sell each stock when it was up 20% while it was still advancing. So that, I mean, everybody's going to be a little bit different, but I feel like this is kind of end game, right? Where you're taking the pitch, you're hitting the pitch, and that is your swing trade. If you don't get stopped out, you're actually holding it and you're waiting for that bigger picture because, you know, the rule they say, you know, you can't go broke making profits or taking profits. But in reality, you can, because if on a swing trade level, even Christian Quilamagi is only batting rate of like 30, 35%. So if you just sell everything too soon, your profits aren't going to be big enough to outweigh your losses in that point. So you need to have that ability to have that discipline, like he said here, to not continuously add and be able to position no more than past the 5% and then sell at 20% while the stock is still advancing. One thing I wanted to point out too, and I really need to learn and understand this, and I'm going to do a deeper dive. I'm going to actually search for more information about this. But he says there's a certain case though. If a stock ran up 20% in just 2 weeks, he would sell if it's above the 20% rule. If the stock was so powerful that it vaulted 20% in only 1, 2, or 3 weeks, it had to be held for at least 8 weeks. Then it would be analyzed to see if it should be held for a possible 6-month long-term capital gain. So the reason why I want to amplify that is because, you know, I know if some of you guys took a few of the trades that, you know, I was talking about in the Discord, and I made the right, you know, basing breakout patterns, and we focused on the leaders, we followed all of our rules. If you're in those stocks, some of them are in the 20% gains. We can take a look at some of them. If you look at my screen here, when we took Tesla at this basing breakout, you can see Tesla is up that 20%. So in this basing breakout, like you see here that we did call out in the Discord, of course, this isn't following all of CanSlim rules on Tesla, but hear me out on the buy and sell rules, that it could be considered a super stock. That's not the exact wording, but this might be something that I might want to hold for a longer term. But I can't just change my rules in the middle of a bull run. I need to stick to my plan, and my plan is close of the 10-day moving average. So, you know, I have a long time to wait to see what happens with that. But I wanted to point that out because it's something I've been thinking about a lot, and that is the plus 20% rule in 3 weeks. So that's all about the first chapter, and I think that covers most of it. But we're gonna just jump right in to the next chapter, or no, I'm sorry, not the next chapter, but part 2 of the segment. We have some charts on here that I want you guys to take a look at. So if you have your books, the charts are over here on page 264. And if you're not muted, if you could mute yourself, Libby, that would be awesome. Thank you. And of course, guys, if you have anything that you want to talk about before we carry on, anything from part 1 that you guys want to talk about or chat about at all? I know B. Stewie and I were chatting for a while, but about this. But do you guys have any questions?
Hey, Dave, I got something.
Let's talk.
It was Dreyfus talking about being in stocks $20 or more. I could tell, you know, since last year. My problem was I always told you my account's small, so I couldn't really be in the higher dollar stocks.
Yeah.
But I've done a lot better since I've been in the $20+ stocks than I have in the crap tickers, you know.
Yeah, absolutely.
So
There's a lot of emotion in those crap tickers, and and we like to call them shit tickers because that's what they are. They're garbage. They're shit, and that's the reason why I call them that. And of course, if you have a you know a strategy that makes you money in playing those tickers, 100%. Don't don't let me stop you. But it's just not the way I trade. It's not. I don't have the ability to do that. I've tried it. I tried it for 2 years straight. I broke even basically on most of it just because my swing trades were making me money and my day trades were I was getting my butt kicked. Or not my yeah, because usually you're day trading because I'm not going to put my money into a crap ticker and leave it for a swing trade. So usually if I'm looking at a crap ticker, it is for a day trade, and day trading is what's been kicking my butt. But no, you're absolutely right. But we
Another thing was I kind of and
yeah, I think B Stewie's cutting out real bad. I think we're losing B Stewie. B Stewie's got the worst internet in the world. We need somebody to contact Elon Musk. Send him over send him over some Starlink. The poor guy, man. We talk so much on the phone. B Stewie has so much insight, so much knowledge. He's been kicking ass and reading. We really do need to get you on here with good quality connection because we need to get more of your chatting on here, Stewie. Does anybody else with good connection have anything? All right, well, let's start chapter 2. 2 things to remember about selling. Before we examine the key selling rules one by one, keep these 2 key points in mind. First, buying precisely right solves most of your selling problems. If you buy exactly at the right time of a proper daily or weekly chart base in the first place, you do not chase or pyramid a stock when it extends into the price more than 5% past a correct pivot buy point. You will be in a position to sit through most normal corrections. Winning stocks very rarely drop 8% below a correct pivot buy point. In fact, most big winners don't close below their pivot point. Buying as close to that pivot point as possible is therefore absolutely essential and may let you cut the smaller number of resulting losses more quickly than 8%. A stock might have to drop only 4% or 5% before you know something could be wrong. Second, beware of big block selling you might see on a ticker tape or your PC. Just after you buy a stock during a bull market, the selling might be emotional, uninformed, temporary, or not as large relative to past volume as it appears. The best stocks can have sharp sell-offs for a few days or weeks. Consult a weekly bias stock chart for any overall price perspectives to avoid getting scared or shaken out in what may just be a normal pullback. In fact, 40 to 60% of the time, a winning stock may pull back to its exact buy point or slightly below and try to shake you out. But it should not be down 8% unless you chased it too high in price when you bought it. If you're making too many mistakes and nothing seems to be working for you, check and make sure you're not making a number of your buys 10, 15, or 20% above the precise correct buy point. Chasing stocks rarely work. You cannot buy when you get more excited. So there's a lot to unpack there, guys. And, I think you guys hear me. If you've been with me long enough, I always talk about not chasing stocks and waiting for them to catch up to the moving averages, not buying extended. If there's a base, we'll just use Tesla, for example. If you have a base here and things are running, this is the buy point. So if you want to get into this buy point and things are running and we measure off of this, 5% is only right here. That's the first day. That's basically buying the first day here. So that way your 8%, as he says, is somewhere about right here. Okay? So now your risk reward is looking much, much better. But this is the pivot buy point that he talks about. Now, this is a bad example because this is Tesla. It's below a 200-day moving average. You know, it doesn't have the earnings and sales growth right now. We should look at something more like RBRK, okay? So here is the basing breakout right here. You wouldn't really want to buy much past this 76.75, in my opinion. You could use 75.70 if you'd like to. But regardless, past this, over that 5%, you're getting into scary territory because it's starting to get extended. It's not just getting extended from what I consider extended from a 10-day moving average, but it's also getting extended to the point where your risk, you would have to risk about right here if you took that top, which that's actually still a decent risk right there if you took something like that. But you know, any higher than that, it's getting a little treacherous. And then that's how I perceive it. That's how I'm ingesting how William O'Neill is taking those exact tickers. And of course, he talks about the weekly. He talks about the weekly, you know. So if you're looking at a buy point on the weekly, you know, yeah, I would still say that 75.60 would still be your pivot point. Now that is all into interpretation on how you take in the stock, how you ingest it, or how you use either anchored VWAP, or maybe you use point of control, or like B. Stewie using both of them in tandem, or maybe it's you know, where your largest areas of consolidation on the price action are. However you perceive it, know where those areas are and know where your pivot points are, because you know where to buy correct. If you've been with me long enough, you know the basing and trend breakouts. I absolutely love the base and trend breakouts. I'm starting to more nurture those simple base breakouts too. But know your pivot point, guys. Do you guys have any questions about that? It was kind of a lot to unpack. Now, I know it might be difficult if you're not used to playing base or trend breakouts. Actually, I was just speaking with Carl a little bit about it. It's a kind of a learning curve. But once you see a few of them, once you understand how they work and how the new higher lows kind of pull in and how there's a flat top and how it gets tight after expansion, it consolidates into a tighter area, you start hearing the same jargon that's coming out of my mouth. Eventually, you're going to be like, oh, this has what it takes. And then you'll start looking into other things like the EPS and the sales growth. But the technical pattern is very, very important because you want to find that pivot or that basing breakout, just like he talked about in this portion of the chapter. Now let's talk about technical sell signs. I'm really excited about this because this talks about climax tops. This is what we're waiting for. We're waiting for these climax tops. So here we go. Technical sell signs. By studying how the great stock market winners, as well as the market itself, all topped, I came up with the following list of factors that occur when a stock tops and rolls over. Perhaps you've noticed that few of the selling rules involve changes in the fundamentals of a stock. Many big investors get out of a stock before trouble appears on the income statements. If the smart money is selling, so should you. Individual investors don't stand much chance when institutions begin liquidating large positions. You buy with heavy emphasis on the fundamentals, such as earnings, sales, profit margins, return on equity, and new products. But many stocks peak when earnings are up 100% and analysts are projected continued growth and higher price targets. You hear that? While analysts are still projecting continued growth and higher price targets, the stock's already telling you in the technical analysis that there is going to be some selling. Maybe not that there's issues with the company, but there's issues in the investor sentiment, okay? On the same day in 1999 that I sold Charles Schwab stock on a climax top run-up in exhaustion gap, one of the largest brokerage firms in America projected that the stock would go up 50 points more. Virtually all of my successful stocks were sold on the way up while they were advancing and the market was not affected. A bird in the hand is worth two imaginary ones in the bush. Therefore, you must frequently sell based on unusual market conditions or market actions, price and volume movement, not personal opinions from Wall Street. You must wean yourself from listening to personal opinions. Since I never worked on Wall Street, I never got distracted by these diversions. There are many signals to look for when you are trying to recognize when a stock could be in a topping process. These include the price movement surrounding climax tops, adverse volume, and other weak action. A lot of this will become clearer to you as you continue to study this information and apply it to your daily decision making. These rules and principles have been responsible for most of my better decisions in the market, but they can seem a bit complicated at first. I suggest that you reread Chapter 2 on chart reading and then read these selling rules again. In fact, most of the IBD subscribers I've met at hundreds of our workshops who have enjoyed real success with their investments have told me that they've read this entire book 2 or 3 times or even more. You probably aren't going to get all it in one reading. Some who have been distracted by all the outside noise say that they read it periodically to help them get back on the right track. And that whole portion, guys, is just solidifying the fact that technical analysis is king. I say it all the time. Technical analysis is king, or price action is king. It doesn't matter what anybody says. It doesn't matter who's selling. It doesn't matter if Warren Buffett is selling. I mean, it kind of matters because it's a pretty big deal, but who cares about the analysts? Who cares about price predictions? Who cares about any of that? I care about risk management. If I'm making money and I'm using that momentum to continue to make money, that's great. If I'm not making money and we start to lose our momentum, first of all, I don't want to wait around for that money to start flowing in again. And second off, I want to use that money that I have to wait around with to put it in something that's going to continue higher and use momentum for it, okay? Those technical sell signs are extremely important, and opinions are worth jack squat. One thing I was going over with B. Stewie actually is, we'll say something and we still have that flavor where we have to say, well, anything could happen. But I was like, finally, we're to the point where I can just be like, yeah, I'm bullish tomorrow. Even though I don't have to explain myself to him, that of course, just because I'm bullish doesn't mean the stock market's going to go up or that I'm going to take a trade. It just means that I'm biased to the bullish side, but I know damn well I could be wrong. It could just completely fail, but just so you guys know, in the SPY extension, I am not bullish right now. I am expecting a pullback to the 10-day moving average, but I have said these same words before and we continued higher. So we will see. Back to the story at hand, climax tops. Many leading stocks top in an explosive fashion. They make climax runs, suddenly advancing at much faster rate for 1 or 2 weeks after an advance of many months. In addition, they often end in exhaustion gaps. When a stock price opens up on a gap from a prior day close on heavy volume, these and related bull market climax signals are discussed in details here. 1. Largest daily price up run. If a stock price is extended, that is, it had a significant run up for many months from its buy point off a sound and proper base, and it closes for the day with a larger price increase than on any previous up day since the beginning of the whole move up, watch out. This usually occurs very close to a stock's peak. And one of my favorite calls that I like to bring up was SMCI. Let me bring this up, and if you guys want to look, you can take a look at my chart here. There's quite a few of them, but this is one of them all the way back here in 2023. So wow, I can't believe we're 2 years past this already. But we watched this capitulate, Covey and I, an old friend. And as this thing moved up, I actually called the climax top right here. And guys, I'm not saying this to brag. I don't want anybody thinking I'm bragging. I'm just saying we had this huge gap up, and then in the after hours, we continued to run up even higher. And I said, well, we are going straight up at this point. I don't trust SMCI, and I sold all of my shares as it pulled back here. I sold most of my shares into the earning gap up, but I left a piece for a runner because I'm a sucker for leaving a piece on. And then it stopped me out when it came back to the close of that top day because it flushed and it flushed fast. So this was a climax top, absolutely beautiful. Let's look at it on my charting here so you guys can see the volume too, because he talks about the volume in here. And look at that. Of course, it did catch and it held that 21-day moving average and continued higher. But that's not what I want to focus on right now. Right now, I want to focus on, we found the climax top here, and look at the volume. The volume is higher than any other day here. Any other day. Climax volume, gap up, another gap up, and then we have exhaustion here. And SMCI has not been the same since. Of course, it's been a fan favorite, but ever since it started its stage 4 downtrend, a thing has not been on my radar. Now it's peaking up above a 200-day moving average, but it's got so much proving to do. Anyway, back to the task at hand. Number 2 is heaviest daily volume. The ultimate top might occur on the heaviest volume day since the beginning of the advance. 3, exhaustion gap. If a stock that's been advancing rapidly is greatly extended from its original base many months ago, usually at least 18 weeks out of the first or second stage base, and 12 weeks or more if it's out of a later stage base, and then opens on a gap up in price from the previous day's close, the advance is near its peak. For example, a 2-point gap in a stock's price after a long run-up would occur if it closed at its high of 50 days for the day, then opened the next morning at $52 and held above $52 during the day. This is called an exhaustion gap. Climax, and that's what we showed you in SMCI right here, guys. You can see that, it gapped up, it held, it gapped up, it held. I mean, you can see this is climax top activity for sure. It's gapping up, it's never coming back, it's never taking a breath, it's just so exciting. Climax top activity. Actually, let me go to signs of distribution. No, sorry. Climax top activity. Sell a stock advance gets so active that it has a rapid price run up for 2 or 3 weeks on a weekly chart, or for 7 or 8 days in a row, or 8 of 10 days on a daily chart. This is called a climax top. So another one right here, you can see it. 8 days in a row. 1, 2, 3, 4, 5, 6, 7, 8. Climax top. SMCI, I'm just pulling this out of the magic hat, guys. I mean, there's a reason why it's written down, and I'm just bringing it up. I haven't brought this up before. We're putting this right in as you see it, and it's working. Why? Because William O'Neill, he is the investment genius who wrote the plan for us to follow, and we're following it. Let's continue. In a few cases around the top of the climax run, a stock may retrace 2 prior weeks' large price spread from the prior week's low to its high. Point and close the week up a little with volume remaining very high. I call this railroad tracks because on a weekly chart, you'll see 2 parallel vertical lines. This is a sign of continued heavy volume distribution with a real additional price of progress for the week. So I don't know if we're going to see that in this, but let's throw this on the weekly time frame and let's see if we can see some railroad tracks. Let me make this a little bigger for you and throw the weekly up here. All right. So, I mean, I guess you could consider this like the railroad tracks on the weekly time frame, but it's still continued higher. But of course, after that, after, if you wanted to consider the railroad tracks the climax top, you could. It did go higher, but after it pulled back, it never got back up above that. So, not the best example on the weekly, but still, understanding these climax tops on the daily is easier for me, especially if you're looking for those exhaustion gaps. It is very interesting. And the 8-day. The 8 days is kind of a learner for me. If it's going up 8 straight days, we need to be very careful with it. So technical sell signs. Signs of distribution. After a long advance, heavy daily volume without further upside price progress signals distribution. Sell your stock before unsuspected buyers are overwhelmed. Also know every savvy investor are due to have long-term capital gain. Stock splits. Sell if a stock runs up 25% to 50% for 1 or 2 weeks on a stock split. In a few rare cases, such as Qualcomm, at the end of 1999, it could be 100%. Stocks tend to top around excessive stock splits. If a stock's price is extended from its base and a stock split is announced, in many cases, the stock could be sold. Increase in consecutive down days. For most stocks, the number of consecutive down days in price relative to up days in price will probably increase when the stock starts down from its top. You may see 4 or 5 down days followed by 2 or 3 days up, whereas before you would have seen 4 days up and then 2 or 3 down. So this here, they're just saying, in the sense of, distribution, and then the down days. I'm sorry, guys. I'm scurrying for a kind of like an example here. But, you get a few up days here. Well, these are climax, but when you get a few up days here, he's talking about counting the up days and counting the down days. It's not something I really do. I'm just looking for the new higher lows here is what I'm doing. So if you want to, you can unpack that further in counting the days. It's not something I've ever gotten into, but I like it's something different. Upper channel line. You should sell if a stock goes through its upper channel line after a huge run up. On a stock chart, channel lines are somewhat parallel lines drawn by connecting the lows of a price pattern with a straight line connecting 3 high points made over the past 4 or 5 months with another straight line. Studies show that the stocks surge above their properly drawn upper channel lines that should be sold. One of them was B. Stewie. I hope you're still with me. Was it HWM? What's the aerospace and defense stock that I wrote out the regression channel lines on? Because I think that's a great example. HWM, maybe? Yeah, okay, so it's HWM. So let me just show you those regression lines on here. So this was really simple to do, guys. I just pulled it from the base to the top, and then this is the one he's talking about. You're grabbing it from here, and you're just pulling it up. And you can see, look, when this thing broke its regression channel here, it broke, and it was not a good time to be in it. So it was a great time to sell when it broke this, right? And then, well, that could be argued. Depends on when you woke up that morning. But then once it got back into its regression area, and now look, it's breaking its channel upwards. Now, it broke it on earnings. I call this a simple base breakout, but it happened on earnings. It happened, and it happened with good EPS and sales growth. And look at this. It has continuation, breaking its regression line higher. I consider this a leader in that aerospace and defense. Of course, there's many, many more, and B. Stewie might argue with me on who the leader is, but I do like HWM. It's more of a boat than anything, but we're seeing awesome growth here, guys. Okay, any questions on that? We only got a couple more to go through here, and then we'll check out some charts. Do you guys have any questions about the maybe regression channel lines, the increased consecutive down days, or the signs of distribution? What's up, Sam? I just seen that you snuck in here. It's good to see you. Glad you made it. So we are on page 264, and at the very bottom of that page there, you'll see Bethlehem Steel. And it's really cool. It draws these out. We always need to keep in mind that this is on the weekly time frame, okay? So Bethlehem Steel, it runs up and it makes what? Oh, look at a high tight flag. You guys probably never seen one of those if you've been with me. And then, of course, that perfect buy point, that pivot point right there, absolutely beautiful. And then, look, it continues higher, much, much higher. And then he's showing here the climax top where it just jets up. And then it says the stock's down 30% in 3 weeks. And you can see here, too, it's closing below that moving average that he has right there, okay? That is a climax top. That's a sign to sell. And if you're not sure, you can do like I do, sell the majority of it and hold on to a small piece and regret not selling that. Next is Utah Securities on page 265 at the top. This one's a beautiful trending up chart with some basing breakout patterns with some retests. Now, I know I can't show you exactly where everything's at, but What we're focused on right here is the selling of the climax top. Now, you don't see that it's accompanied with the volume of a climax top, but you can see how it's jetting almost straight up. Look at that. And you can also see, we have all this tight action and we have significant movement. When things move, from $60 to $120 in just a couple of weeks, that is a 100% move. That on anything is a good take. If you're fighting with taking after 100%, you're a greedy bastard. And remember, pigs get slaughtered. You know what I mean? But of course, if you want to save a piece, but just remember, these climax tops, if it's going to move up 100% in 2 weeks, you're looking for climax tops in that. Food fare on the weekly chart here, you can see he's talking about that large split. So that sell climax top, you get this large split, the 4-to-1 split on heavy volume there. He's saying, he wants to get rid of it, that's a climax top there. I haven't really messed with anything with splits. My biggest learning curve was watching the video when it split and having to refer to that 500 basing breakout area. That was the best basing breakout that I will always refer to probably for the rest of my career. Right here, back when it was, $500 and now it is 50 because of the split that they did. But this was the picture perfect basing breakout that I told all my friends and family about, that I did not make nearly as much money on because I wasn't as disciplined in my sell rules. But you can see here, just using the 10-day moving average as it breaks out here, it has much higher. So can we find the climax top in this? Let's take a look. This almost looks like a climax top here. Without looking at the volume, we see gap ups here, gap ups here. It looks like, in a big volume exhaustion kind of day. And it looks like it did come back down, and it couldn't get higher than its previous high. It sells off here, and look, it comes back to life, gets tight again, and then continues higher. But right there, that would be a sell, and this would be a rebuy back in point. And then you're missing the big dip here. Now, you could say, oh, well, if you could have just held, that would have been more simple. Well, you didn't know it was going to stay. You had no idea that this was going to stay. This could have rolled right back on over and headed lower, okay? So that's why we have buy and sell rules, because this could have ended up turning into something much worse, okay? But now, as we know, NVIDIA, now this is much worse, right? Same thing with here, if you don't have sell rules. Anyway, guys, climax tops, we're looking for climax tops. This looked like a climax top. It sure acted like one, same as this. I hope those were good examples. Tops chewing gum, weekly chart, 265, bottom page. This is the example with the regression line here. It shows sell break above the channel line. So back to the HWM. Here's my regression line. He's saying that you would sell after it broke this regression line. So that's an interesting take on that. I like that. So absolutely like that. On the next page, we have quite a few more charts. You guys, these are something to definitely study. It's definitely something that you need to be doing on your own time. Studying history's past is something Christian Quilamagi constantly talked about. So if you want to learn and understand climax tops, you need to look at climax tops. And when they happen, you need to be aware of them and you need to take a note on them. Let's look at MSTR. That was the most recent one that we called. Right here is a climax top. You can see huge run up here, but it gets tight. It doesn't continue gapping up. This here, though, you can see we get a big gap up and then into the next day. The next morning, just use this example, but Jolene and I, B. Stewie, Dan, we were all on here and we ended up, seeing this climax top. I called this out. I mean, this wasn't actually from reading William O'Neill. It was just from watching so many climax tops and being in, a few market cycles. You start to learn these. They kind of look the same, where they're just sticking straight up like this. Now, calling the top of one is hard, right? It's nearly impossible to call the top. But if you're in this stock, it's nice to be able to sell the majority of your shares into these. So that's why you want to learn and study, because that's what we're waiting for. You get a basing breakout like this, you want to hold on to this thing into a climax top, right? At least a portion of your proceeds. Let's continue on. Do we have any questions about that? I mean, there is a lot to unpack there. So if you guys have any questions about that, throw it in the chat or unmute yourself and let me know. I'm going to take a sip. It was more of a chug, but a well-earned chug it was. Okay, so let's talk about low volume other reaction action. Now, I don't, I'm really not too much of a stickler on volume. I try to stay away from volume. Now, you know, I like to note it when it's higher than average volume when I'm taking it on my pivot points and my break points. But other than that, I don't try to dive too deep into it. But let's hear what William O'Neill has to say about it. Low volume and other weak action. New highs on low volume. Some stocks will make new highs on lower or poor volume. As the stock goes higher, volume treads lower, suggesting that big investors have lost their appetite for the stock. Now, guys, we do talk about the volume contraction pattern by Mark Minervini, and it's where we're seeing big bouts of volume on the way up, and then as the stock starts to contract, we're starting to see volume dry up. But in this case, he's saying that you don't want to see new highs on low volume. You don't want to see this extension with very little volume compared to the rest of it. If you want to see proper action, you want to see volume as these are starting to rise. You want to see volume coming into this stock. As it starts to go higher, you're seeing volume accompanied with it. If you're seeing the stock go higher on lower volume like this, you know, it's moving higher, but it's on lower volume. It's moving higher. Well, this is on higher volume, so that makes it a little tricky. But look at, it's not, you know, all this selling volume here is much, much higher than all the buying volume. So, that makes it tough. Closing at or near day's price low. Now, we talk about this. I'm not going to just read this verbatim, guys, but when stocks, like I was just telling B. Stewie today, RBRK, I said, boy, what a close. This is what you want to see when you own a stock, guys. You want to see the stock closing at highs. It shows the investment or the investors, have an overall sense of positivity about the stock because they're not trying to sell before the day's end. They're not trying to exit the stock because they're worried about holding it overnight. No, if this thing's already extended and it's closing at all-time highs, that is showing excitement. It's showing, oh, I gotta let my wife in. I locked her out. Hang on, guys. Woo, this is fun. Okay, where were we? Okay. So when things close at their all-time highs, it's bullish. It shows really, really good sentiment that people are excited. They're not afraid to leave their money in overnight. They're not fearing that extension. Okay. Third and fourth stage bases. Now, I'm not going to give this verbatim either because I really want to get through this, guys. But the third and fourth stage bases, when we're looking at stages, and I'll just use MSTR as an example, it's starting to set up a second stage base. So right here is the first stage base because I consider this a trend and a basing breakout. You can see the base form right here above all moving averages as it holds its lows and makes new lower highs. This first stage base breaks. It breaks out, and now look, it's starting to form this second stage base here. Okay, and that's how I'm interpreting it. I think I might need to read in a little bit deeper here because, let's see, sell when your stock makes a new high, the price of a third or fourth stage base. The third time is seldom a charm. Yes, okay. So, and he's talking about, when it makes that third or fourth stage base, it's going to get exhausted. People like the new hot chick. They want to find the new cool stock. It's only going to go so high, right? It's not going to keep going straight up. After expansion, we need contraction, right? And after a stock expands so much, too many times, it's less likely for it to continue expanding, right? How far can you stretch a rubber band before it snaps? Signs of a poor rally. When you see initial heavy selling near the top, the next recovery will follow through weaker in volume. Show poor price recovery or last fewer days. Sell on the second or third day of a poor rally. It may be the last good chance to sell before the trend lines and support lines are broken. So one of the things I think, let me just reread that. When you see initial heavy, okay, so he's talking about heavy selling volume near the top. So I'm still confident in this because every time this goes up, it's going up on higher volume. This is a little bit higher volume on the lower, but look, we're starting to make new higher lows on this. It's starting to get tight, and we're not getting big selling volume at this top here, okay? Now, if we hit this top and we sold off really hard, we came back up, hit this top, sold off really hard, well, that just tells me there's a big seller up there, that nobody's interested in this price and there's too much supply. So until that gets broken through, I don't want a part of it. When it comes back up, you might want to get out. Is signs of a poor rally. Okay, and this might be on the wrong time frame here. When he's talking about rallies, William O'Neill's looking at these things on a much larger time frame. So I'm showing you this on the daily time frame. You know, in the end game, it would be great to only look at that, but you know, if you want to use a weekly time frame and get used to the weekly time frame, do it. Absolutely. I try to only use the weekly and the daily, and sometimes I try to hone in everything on the hourly. If there's an inside hourly trend that gives me a better time frame. Other than that, it's opening range breakouts. It's the only reason why I'm moving in and for the volume. Decline from the peak. After a stock declines 8% or so from its peak, in some cases, examinations of the previous run-up, the top, and the decline may help you determine whether the advance is over or whether a normal 8 to 50% correction is in progress. You may occasionally want to sell if a decline from the peak exceeds 12 to 15%. So we're talking about huge run-ups here, guys. So you can't be afraid of an 8% if it's still within your range. So let's use MSTR for example. So I'm in this stock. I took this basing breakout. Of course, I use MSTU because it's 2x leverage. Cost me less money to trade it. If this were to decline from its peak and we just pull this down to 8%, this could be a normal movement. Anything below that, between the 12 to 15%, would be here, which would be right now below the 21-day moving average. Okay, so he's pulling the percentages there. I'm using moving averages, which is roughly the same as what he's using. So I'm using a 21-day moving average. He's using that. I'm actually using a 10-day moving average because I'm trying to capitalize on this momentum and not really protect my downside because I just want to keep on stacking on those wins. I'll start tweaking my I'll start tweaking a little bit of that later. Okay, let's go through this. I don't want to rush through any of this. You know what? There's going to have to be a part 3, guys. There's going to have to be a part 3. I just don't want to rush through any of this. I don't want to feel like we need to just run through it. And I feel like I'm getting a little too excited right now because I feel like I'm trying to cram too much in. And I don't think that that's right. I think we need to stay at this pace and just take a nice little chill pill. And we're going to do a part 3. I think we need to focus more on this. I really do. And if you guys can just look through your books and highlight any sections that you might want to review after we're done doing the 3rd section of chapter 3, because I think it would be great if you guys could kind of chime in and maybe pick one thing from this book that you think is the most important. And if we all end up having the same thing, that's fine. But I think it'd be great to have you guys all kind of just chime in, you know. And I'll have B. Stewie help me remember, and I'll make him have better internet so he can be a part of it. But guys, that is How to Make Money in Stocks, William O'Neill's Chapter 11, Part 2. You guys are awesome. Do you guys have any questions for me? I mean, I don't want anybody to feel left out here. B. Stewie, Carl, Jimmy, Libby, Sam, Yosef, I'm calling you out now. What's up? What do you guys think? Do you like the reading? Talk to me, baby.
Absolutely. Good learning.
I love to hear it, Jimmy. And I love your dedication to you, brother.